Alrighty, so this is an overview of the Federal Reserve System. This video is going to be a little bit long. You can probably see whatever the minutes are, uh, but this is going to be it. This is just one big video. So anyway, here we go. Uh, so we have what they call a Federal Reserve System, and the Federal Reserve in the U.S. is our country's central bank. All right, they handle the country's money. All right, in short, I mean, there's a lot more to it. They control the money supply. All right, and so just in general, if the economy's doing bad, they want people to buy stuff. They put more money into the system. If the economy's got inflation, then they would want to take money out of the system. There's a lot of debate as to whether, well, maybe not a lot, but there's some sectors in the U.S. Political realm that think that the Federal Reserve System is bad. Uh, that's up for debate. But anyway, we are. This is what we have now. So anyway, so the Federal Reserve System was established in 1913. So I just want to go over the basic structure of the Federal Reserve, and then we'll get into some of the specifics. So it was established in 1913. It is a quasi-government institution. Quasi-government. Meaning, we don't elect anybody on the Federal Reserve. All right. Uh, they are, well, we don't elect them. They the, they are an independent body. All right, and that means that neither the president nor Congress can tell them what to do. All right. Now they do have to report. Have to report to Congress. Okay, Congress can call up the head of the Federal Reserve, and we'll look at that in just a second. But they make reports to Congress on how they think the economy is doing and what kind of policies they have and so forth. So the basic, well, let's back up a little bit. So their goals of the Fed, and we call them the Fed for short. Goals of the Fed, and you'll recognize these from before, are price stability. Remember, don't want to have bad inflation. Price stability and full employment. And the last one should be rattling off your tongue right now. That is economic growth. Okay? And so they try to achieve these three, and these are the three macro objectives. Seeing them again. Remember, we did fiscal policy, and the federal government, being Congress and the president, use these three goals to guide their taxing and spending decisions. So the Federal Reserve System uses these three goals to dictate what they do basically with the money supply. All right. If the economy is bad, they do one thing. If the economy is good, then, or if we're in a recession, they do one thing. If we have inflation, they do another. But anyway, so this is kind of the gist of it. Again, 1913. So let's look at what the structure looks like. All right. So this guy, whoops, over here. Let me just drag him, and then we'll. Oh, don't know why that's happening. All right, I think you can squeeze in and see his face there. That guy is the head of the Federal Reserve. His name is Ben Bernanke. Some people call him, or whoever's holding that position of the Federal Reserve, the chairman of the Board of Governors. Some people call that person the second most powerful person in the U.S., only behind the president, but we'll get to that in just a minute. Hang on just a second. Alrighty. Uh, so anyway, so this is the structure. And, this is going to tell us, let me get rid of him. This is going to tell us how we relate to the Federal Reserve System and how it looks. So we've got, at the top, we have the Board of Governors. There are 7 members in the Board of Governors. All right, and this is the top group. All right, so we've got 7 members. They are nominated, let's see, they have 14-year terms, which is a long time. So 7 of them, so every 2 years, one comes up for, a new spot comes up. All right, typically they only serve 1 term. So it's a 14-year term. They are nominated by the president and confirmed by the Senate. All right, and their main job is to decide on monetary policy. They have a little help here. All right, and that help. So we got these 7 members of the Board of Governors, and Ben Bernanke sits at the top. Bernanke. All right, so that's this group. Now this Federal Open Market Committee. This is Federal Open Market Committee takes the Board of Governors. All right, so that's them. There are 12 total members. 7 of them come from the Board of Governors. All right, and then the other 5 come from presidents of Federal Reserve banks. And that'll make sense in just a second. All right, and so there's 12 total members on the Federal Open Market Committee. Their job is they're the ones who decide which specific monetary policy to conduct. All right, and this will all make sense in just a little bit. So we've got the Board of Governors, 7 members, 14-year terms. The Federal Open Market Committee, there's 12 total, 7 of them from the Board of Governors, 5 from these Federal Reserve banks. So there are 12 of these Federal Reserve banks located around the country. So let's take a look. This is where they all are. And so the job of these banks, these are private banks, but the job of these banks is to help carry out Federal Reserve policy. So we are here, all right, and so we are in District 6, and our Federal Reserve Bank is in Atlanta, and you can drive there and go take a tour if you like. But if you're living in Kansas City, or if you're living in Zone 10, then Kansas City is where your Fed is. So there's 12 of these altogether. And so when we talked about the Federal Open Market Committee over here, these 5 extra members, they pick 5 of these folks. All right, so not all 12, but just 5. And one of those always has to be from New York. So the 5 over here, 1 from New York, and then 4 from the other places. So anyway, so those are the Federal Reserve banks, and then they have member banks, all right? And so here's us down here. And so how do we relate to the Fed? So let's look at a couple of duties of the Federal Reserve, and then that'll hopefully make it a little bit clearer. So duties of the Fed. Invisible ink there for a minute. So duties of the Fed. The first thing that the Fed does, these aren't in any particular order, they are what they call the banker's bank. All right, and so let's go back over here. Not there. How about there? So here's the member banks. These are the banks that you and I would use. So this is like USAA Bank, the bank branch of their company, Wachovia, I guess they're not around anymore, Wells Fargo, Citibank, all the banks that you and I would use. So here's how this relates. Here we are down here. We put our money into our banks. And so when we say the Federal Reserve acts as the banker's bank, they're going to take their money and basically deposit it in the Federal Reserve banks. All right, and so this is how this flows. All right, so you got the Board of Governors and the FOMC controlling monetary policy, and the Federal Reserve banks within each zone help implement it. And our bank, the ones that you and I would use, and other depository institutions, they are members. They put their money into the Federal Reserve banks, and then we put our money into there. So that's the flow. All right, and so they are the banker's bank. So if we go and deposit, $100 into our bank, then they will send it to Atlanta and deposit it in Atlanta. All right. So they're the banker's bank. They are also the government's bank. So when we pay our taxes get deposited in the Federal Reserve. Taxes deposited in the Federal Reserve. When the government sends out money, when they cut a check, maybe like a Social Security check or whatever, then it comes out of the Federal Reserve. And so just like you and I would use Wells Fargo, then the federal government uses the central bank or the Federal Reserve. All right. So they are the government's bank. They also are in charge of regulating banks. And they just want to make sure that the banks are healthy. And over the last few years, back in 2008, when the Great Recession hit, the banks were at the kind of the center of the firestorm, and so some people were critical of the Federal Reserve for not regulating the banks as strongly. But again, it's another discussion. So, but they regulate the banks, make sure that the banks are healthy, and then finally, they are responsible for conducting monetary policy. All right. So, and there's a couple other ones, but these are the main ones. So the bankers' bank, they're the government's bank. They regulate the banks and make sure that the banks are staying healthy, and they conduct monetary policy. So this is the one that we need to look at a bunch. Now, just for us and our class, the end of course test folks like these kind of questions. It seems not as relevant to understanding, but they like these kind of questions, 7 members, 14-year terms, all that stuff, what the FOMC is. So anyway, that's what they like to do. All right, so let's look at monetary policy. All right, let's get down kind of into the nuts and bolts here. So let's say that this is our economy. All right, so our aggregate demand, short run aggregate supply, quantity, price level. Let's put the long run there. So we'd say that we're in a recession because we're to the left of that long run curve. All right, and so remember this is C plus I plus G plus NX. All right, so this is this is the economy. And so the other graph that I want to look at that we haven't really done before is the supply and demand of money itself. All right, so the supply of money and the demand for money. Now, when we talk about the supply and demand of money, we need to think about what would we put here, because over here we have price level. If we're just looking at specific products, it's price. So what do you think we would put here? And so what we want to say is, what is the cost of money? And the cost of money is the interest rate. All right, so let me get rid of that circle. So this is the interest rate. And so if the demand for money goes up, the interest rate goes up. If the supply of money goes up, interest rate would come down. And again, the interest rate is the extra that you have to pay the bank to borrow the money. All right, and so the interest rates are a big deal. All right, and the Federal Reserve has some control over the interest rate. So here's why they're a big deal. So let's say that here's our economy. In order to get our economy better, we would say we want to shift aggregate demand to the right. All right, or as a side note, we could try and shift short and aggregate supply to the right, but we're not going to worry about that right now. So the Federal Reserve says we want, because we're not achieving economic growth or full employment, so we want to shift this aggregate demand curve to the right. What could we do? What do you think they influence down here? Of all of these, what do you think they have the most control over? And the answer is they have control over those two to a large degree. And so you might ask how. And so think about the money on this side. If interest rates, well, if this is our current situation, then we want consumer spending to go up. We want business investments to go up. All right, and so what might encourage people to go out and spend more, or businesses to invest in factories or new machinery that the Fed has control over, and that is interest rates. All right, if they were to lower the interest rates, then you would hope to see consumers start to spend more and businesses start to invest more, and theoretically that would pull this aggregate demand curve to the right and help with our situation of unemployment and low growth. And so what the Fed can do is, remember, the Federal Reserve has control over the supply of money, and so they can either move it to the left and jack up the interest rate, all right, or they can shift it to the right and lower the interest rate. All right, and by manipulating the interest rate, they can hopefully manipulate consumer spending and business investments. Now, another discussion is they can have a pretty strong influence over net exports, but for our purposes, we're not going to go there. So anyway, so this is what monetary policy is. Monetary policy is, in short, in a very general sense, manipulating the money supply to control the interest rates which will either encourage or discourage people and businesses to spend. All right. So if we have a very inflationary period, let's say we're way up here, all right, and inflation's going up, then we would want aggregate demand to come down. And so we would say, what can we do to get consumer spending down and business investments down? That would be to increase the interest rate, all right, because then it's more expensive to borrow money. All right. So that's the general idea that they want to, their goal is price stability, full employment, economic growth, and they use basically the money supply, the adjustments in the money supply to achieve their goals. All right, so let's look at what those tools that they have are. All right, so there are 3 tools of the Federal Reserve. All right, got to make sure you know these. So the first tool that we're going to look at is something that they call reserve requirements. All right, so let's go back to when we deposited $100 in our bank. So you get a check from Aunt Sally and for $100, and you go to your bank and you put that in. What does the bank do with your $100? They don't just put it in a little drawer with your name on it and say, okay, come back when you want it. They take this $100 and the banks make money by lending it out. All right. Now, the question is, how much of this 100 should they lend out? All right. And so, do you want them lending all 100 out? Is that a good idea? Because if they lent every single thing out, when people came back to get some of their money, they wouldn't have any. All right. And so they definitely have to keep some, but you don't want them to have to keep all of it. And so the Federal Reserve says, we're going to figure out the percentage that the banks need to hold on to. All right. And so the last I saw, if you were a really big bank, you had to hold on to something like 3%, mid-sized banks, something like 10%, maybe a little bit less, and then really small banks, something like 15%. All right, so let's just say that they're a mid-sized bank, and so you go and deposit $100, and if the reserve requirement is 10%, that means that they have to hold on to 10% of that, so they keep $10, lend out 90. All right, and there's another lesson in here that through this lending process they actually create money, which is kind of interesting. But again, for this video, we're not going to go there. So, all right, so we have to do this because we are on something called a fractional reserve system. Fractional reserve, meaning that the banks only have to keep a fraction of the money that you put in, and the money in the banks are called reserves. All right. So the banks have 2 types of reserves. They have required reserves, and this is set by the Fed. So required reserves set by the Fed, and they have excess reserves. All right, and the Fed, to manipulate the interest rates, this is what they want to mess with. All right, and so let's say that so you put your $100 in, the required reserves would be $10. So the bank would have to hold on to $10, and that means that they could lend out 90. All right. Now, when we looked at the supply and demand of money, all right, it's over here with interest rates. What if the excess reserves went up? All right, that just means that the banks have a greater supply of money, and the interest rates would come down. All right. Or if they said, let's try to decrease a bank's excess reserves, then supply would shift to the left and interest rates would go up. And so that's basically what the Fed is doing, and we'll look at how they do it in just a minute. But it's all about the excess reserves of banks, because if they have more money out there, then interest rates go down. If they have less that they can lend out, then interest rates will go up. So one of the tools of the Fed is to manipulate the reserve requirement. All right, and so let's say that that the economy moves bad, all right, bad economy. What could the Federal Reserve do to the reserve requirement to, let's say this is recession, because inflation is bad as well. So let's say that we have a recession. What could we do? What could the Federal Reserve do to the reserve requirement to get people to go out and spend money? What would they want to do to interest rates? All right, and that's the question. So if we're in a recession, what do you want to have happen to interest rates? in order to get people to go, well, you want to get people to go spend, and so you'd say you need to make it cheaper to borrow, and so they would want to increase the excess reserves, and so what they could do is instead of say 10%, all right, what if they said, you know what, let's cut this and make this 5%, so now you put your $100 in, instead of only being able to lend out 90, now you can lend out 95, and so there's more money available for lending, and the interest rates would come down. All right, so that's one tool. What if we had inflation? So if we had really bad inflation, it means there's prices are really high. What do you want people to do? Do you want people to go spend more, or do you want people to stop spending? And you would want people to stop spending, and so what could you do to this reserve requirement to get people to stop spending? You would say, you know what, instead of 10%, let's make it 50%, all right, which means that now they can only lend out $50. The supply of money of excess reserves would go way down, interest rates would go way up, and as interest rates were high, then people wouldn't borrow money as much. All right. So anyway, so this is a reserve requirement. Now, after saying all of that, the Fed hardly ever uses this. All right, you do need to know what it is, but they typically don't mess with this because there's so much money out there. The best analogy I heard was trying to hammer in a little wall nail for a picture with a sledgehammer. Okay, because this is such a big tool. If you manipulate this by a percent, you know, to 4%, there's so much money out there in the system that it would have a huge impact. All right, and they wouldn't necessarily be able to control it as well as they would like. All right, so anyway, tool number one, reserve requirement. Tool number two. Hang on just a second. Sorry. Tool number two is something called the discount rate. This is, remember, the Federal Reserve is the banker's bank, and so when we need to borrow money, we go to our bank. When our bank wants to borrow money, they can go to the Federal Reserve, and the interest rate that the Federal Reserve charges our banks is called the discount rate. So the rate the Fed charges banks. All right, and so they call the Fed the lender of last resort. All right, because we don't want, things are bad. If the banks have to go to the Federal Reserve to borrow money, that means that nobody else would lend them money. And we'll talk about why they're doing that in just a minute. But anyway, so the discount rate is when the Federal Reserve lends money to our banks. All right, so, excuse me. Oh, yeah. All right, so here's how this works. Let's say that, what if we had a recession? All right, and remember, we have required reserves and excess reserves in the banks. All right, and they want to be able to manipulate that. All right, so let's say that we're in a recession and we have poor growth. All right, and so what does the Fed want to do? They want people to start buying stuff. Okay, and so how could they get more money out there? And so what the Fed can do is to say, you know what, we're going to charge the banks, and it's something right now because the economy is still pretty shaky, something like 2%, or actually no, it's like 0.1%, is what I read the other day. So the Federal Reserve can lend banks money and charge them 0.1%, which is nothing. All right, and so the idea would be that, look, let's charge the banks very low interest, basically giving them money. So hopefully that will increase the excess reserves and cause interest rates to go down. All right, and so if interest rates go down, then we go back over to this graph. Whoops. If interest rates go down, then consumers start to buy more, and it shifts up that way. All right. Now, if we have inflation, hang on. If we have inflation, then we don't want the banks borrowing a lot of money, and so they would jack up the discount rate to 10, 15, 20, whatever percentage you want to put on it. They would just raise it. All right. Now, a lot of times this is just considered when the Fed announces their discount rate. This is a signal to everybody, signal to financial world of what the Fed is wanting to do. Financial. So if they lower it to 0.1%, then that's saying, look, we want banks to borrow money and all that stuff. Now, let me do a little side note here, because this was something bad that happened not too long ago. So the Federal Reserve, because of the Great Recession, put the discount rate at 0.1%. All right, so this means that banks could borrow, you borrow $100, and with the interest, you basically have to pay them back $100 and a penny. Nope. Yeah, 0.1%. I think that's right, or something like that. So anyway, basically, don't have to pay them back anything. And so, unfortunately, what the banks were doing, some banks, was to borrow this money at 0.1%, and then they would buy Treasury bonds. We'll talk about these in just a minute, but they would buy Treasury bonds, and so this is the federal Treasury bonds are the way that the federal government borrows money. And so if you buy a Treasury bond from the government, that's you lending the government money, and so they pay you an interest rate. And so the banks were getting this really cheap money from the Federal Reserve at 0.1% and buying these Treasury bonds and earning 3.5% back. All right, and so anyway, they weren't doing what they were supposed to do. The Federal Reserve lowered this to 0.1%, so the banks would borrow the money and lend it to private individuals, businesses, citizens, whatever, and that would hopefully jack up the economy through consumer spending or investment spending. Instead, what some of the banks did was to not lend it to you and I and small businesses or big businesses, whatever. They would take it and basically lend it back to the government. So they got cheap money from the government, lent it back to the government by buying these Treasury bonds, and so that really didn't go over too well. All right, so anyway, that part, you won't be tested on all that, but you will be tested on this discount rate and what it is. All right, so the last part is the third tool is what they call open market operations. Open market operations. And if you need to pause this, if you are zoning out, you need to pause this, then please do so. Probably about 10 more minutes is my guess. All right, so open market operations. This is buying and selling government securities. All right, so government securities. This question is, what are those? So a government security is like a treasury bond, and so let me just start the story at the beginning. The U.S. government, we have a $16 trillion debt. And you might say, where did all that money come from? So when the federal government needs money, because every year, this is our debt, this is our total accumulation of money that we've borrowed, as opposed to what they call a deficit. This is a yearly, how much we're in the hole yearly. And so last year it was something like 1.4 trillion. The government took in a certain amount of money, but they spent 1.4 trillion more than they took in taxes. And so we had what they call a deficit. And so they have to borrow this money, this 1.4. And so the way they borrow it is by issuing what they call a treasury bond, okay, or a bill, a treasury security. All right, this is what we mean by government security. So basically, it's a sheet of paper. Oh no. It's a sheet of paper, I think a little bit of time, that says that, let's say you'll lend the government $1,000. It's called a par value. Don't worry about that. $1,000. They'll pay you 10% interest. I'm just making these numbers up. It's not 10%, but they'll pay you. Let's make it 5. Let's make it somewhat more realistic. So you give the government $1,000. They'll pay you 5% per year for 10 years. All right, and this will be a 10-year Treasury bond. So this is what's called the interest that you receive, uh, and this is what they call the maturity. And so how this works is you give them $1,000. In year one, they give you 5% of your 1,000, so they give you $50. In year two, they give you $50. In year three, they give you $50. All right, all the way down to year 10, they give you $50. And so over the course of the years, how much have you earned from the government? You've earned 10 times 50, so you've earned $500. Also in year 10, they give you back your 1,000. All right, and so whoever holds these, whoever has this piece of paper, is going to get $50 a year for 10 years, and the government's going to give them the $1,000 back. All right, so the Federal Reserve, here's how this ties into the Fed. The Federal Reserve says that they'll go out and either buy or sell Treasury bonds because a lot of people own these. All right, other governments own them. China owns $1 trillion worth. Japan owns close to $1 trillion worth. But banks have Treasury bonds because they lend the government money. Private individuals have Treasury bonds. There's a lot of these Treasury bonds floating around out there to the tune of about $16 trillion worth of them. All right, and so here's how open market operations work. All right, so here's the bank. And let's say that the bank has, and this is kind of a simplified version, obviously, if I'm drawing the picture of a vault. So this is the bank, and let's say that they have two things in their vault. They have bonds, and they have cash. All right, so part of this cash, let me draw that somewhere different. Part of this cash is required reserves, right? And then the other part is excess. And remember, what can they do with this excess? They can loan it out. All right, and they also have all these bonds. So here's what the Federal Reserve does. If they want to, and this is what, let me go back over here real quick. This is what the Federal Open Market Committee decides, all right, whether to buy or sell bonds. All right, and so it's these 12 folks. This is what monetary policy is all about, and this is what they use all the time. All right, so that remember, they didn't use the reserve requirement hardly ever. The discount rate they do use, but this is what they use all the time. All right, so what the Fed does is, let's say that we're in a recession. All right, we want people to spend. And the way you do that is to lower interest rates. All right, and so how could they do that? So the Fed's up here, and the Fed, they print the money. All right, and so they can have theoretically unlimited supply. All right, of money. And they also own a bunch of bonds themselves. All right, and so this is our bank's vault. The Federal Reserve's vault looks similar, except their cash goes all the way up forever. All right, so what we would do in a recession is we want the banks to have more cash. And so what the Federal Reserve would do would be to come to the banks, or they could go to individuals, and the individuals would sell it. But they would go to the banks and they would say, we want to buy a chunk of your bonds. We want to buy these bonds. And so in exchange, so the banks give the bonds to the Fed, and in exchange for the bonds, the Fed gives them more cash. And so now they have more cash up here, so they have more excess cash. That means that there's an increase in supply of money. And again, supply and demand. If we increase the supply of money, then the interest rate goes down, and if the interest rate goes down, then people will go out and spend, theoretically. All right, and it works in the opposite direction as well. If we have inflation, then let me try and touch this up. I'm running against the clock here. Let's get back to where we were. All right, so those are bonds. So if we have inflation, that means that there's too much cash, and so the Fed would say, look, we want to sell you bonds. And so they'll say they're going to take some of their bonds and sell them to the bank. So now the bank gets more bonds here, but the bank had to take some of their excess cash and give it to the Fed. And so the Fed just tucks it away under the mattress basically and takes it out of circulation. And so now we have lower excess reserves. All right. So now we have fewer excess reserves. The supply of money shifts back, and interest rates go up, and people spend less, and that would bring aggregate demand. Oh yeah, battery's going down. That would bring aggregate demand down to the left. All right, and so I'm going to finish this up in a companion video, which will only be about 5 minutes, but I don't want the computer to die. So until next time.